now. Let's bring in Sandra Araullo. She's ATRAM's Chief Investment Officer. Hi, Sandra. Merry Christmas. Welcome back to Market Edge.
Hi, Mimi. Thanks for having me.
All right. So what? Last 5-6 trading days of the year? Nothing left to say, nothing left to happen. This is it? No more red-nosed reindeer around the corner? This is where we end, you think?
Not at all, no. I wouldn't say that nothing is left to happen. In fact, today we have a big catalyst just happening with the passing of the budget. I think what's left is not about momentum, but about positioning. The year ends with the market down about 8%, and it reflects more disappointment and fatigue rather than panic. So certainly it feels like we're closing the year and we're at the finish line, but it's all about the start of 2026 now.
All right. So when you look at the start of 2026, would you say that risk at this point in time is just too expensive? And if so, how do you juxtapose that to the fact that everyone seems to be screaming discount? Everyone's saying we're cheap.
Definitely, risk today is not uniformly expensive, but I wouldn't call it cheap either. I would say it's unevenly priced. So there are some sectors that are genuinely discounted because bad news is already priced in. And there are still other areas that price optimism without the execution. No? So we don't think this is a situation where we call blanket risk on or risk off. It's actually repricing within risk, meaning to say the repricing is happening inside the market rather than across the equity asset class as a whole.
So when you think about repricing, will that mean reallocation away from some sectors or asset classes in general, and which ones?
Definitely, no? So we expect, or we're seeing a move away from hope-based cyclicals and more towards where balance sheet strength and earnings visibility and cash flow visibility is there. So this is not the end of the story. This is the end of guessing. So as I said, we don't think that risk is expensive per se. What is expensive is mispriced risk. So the repricing that is happening within equities is necessary to reflect the fundamentals, and that's actually a favorable thing that we're observing in the market.
So Sandra, when all is said and done, where do you think the index ends 2025? We of course know last year we were up modestly 1.2% after 4 straight years of minus performance. And this year we're still down, as you mentioned, 8%. We're going to have to hit 6,500 just to finish flat. Where do you see this index ending this year? And maybe if you could give us your target range for 2026.
Actually, for 2026, no, pricing what is known, which is all of the fiscal risk execution, a lot of the spending execution. As I mentioned, the market is pricing all of these negatives in today. And we don't expect a rally in the last week. If it happens, it's still going to need confirmation by the first half of the year. And unless we see the execution or execution risk subside, which we're seeing signs of that because of the passage of the budget, then it can trigger confidence to gain some momentum. There is also the matter of the market being a relatively illiquid emerging market. So if foreign flows do come back to emerging markets, we can expect that to be a tide that lifts all boats, and the repricing then happens at the valuation expansion level rather than earnings expansion. So on the base case really is we're about, maybe 6.5 as our base case is just pricing in earnings expectations for next year. And admittedly, it's a very pessimistic, or it's based on some sanguine assumptions. but it's reflecting caution more than a lack of catalysts that we're seeing. No? So the upside is certainly there, but it really remains to be seen on the execution side.
Wait a minute, Sandra. Are you saying your base case for 2026 is 6,500?
Just based on earnings expectations.
And what sort of EPS are you looking at?
A lot of things need to happen, but on the base case and even the street, this year earnings expectations are gonna close 2025 around high single digit, no? So maybe 7%, 6 to 8% this year.
And
so
next year?
We're expecting this more of the same next year if we don't see any improvement in terms of the spending or the again the fiscal side of things. The public sector will have to take the lead before private sector can really follow through meaningfully, and we have all of our challenges on the macro side. GDP growth isn't really expected to come back until the second half of next year. So a lot of things really need to happen in the first half of 2026 for the upside or an improvement in our prospects to happen.
And given all that you just mentioned, Sandra, it's very sobering really to hear this perspective. How much of one's dry powder should they allocate to risk equities like stocks, to risk assets? Is it
So
20?
Well, that really depends on your profile, no. But definitely from a I would say multi-asset perspective, you don't need to go take on a lot of risk in equities to get meaningful returns because of where rates are. So in terms of allocating to equity risk, it doesn't hurt to be a little bit more conservative while we're looking for these confirmations. So at this point, kasi it's about it cannot be on hope. We cannot be buying the market based on hope. Investors are demanding proof. So, like I said, it's not a blanket expensive market. It's not a blanket cheap market. It's really being able to identify where it's priced in. The price is, the upside is there because of certain catalysts that can take place. What do I mean? Let's say, for example, banks. You're seeing disappointment in banks in 2025, but going into 2026, we see that there is earnings visibility. The valuations price to book is very cheap, while your return on equity is pretty stable. So those are certain segments of the market that we think is a good place to stay defensive and while hedging the risk of missing out on the upside, no. So it's going to be a very selective market, but being able to pick those spots can really pay off once a lot of the other catalysts come to line, and there are a lot, no. The thing is, a lot of the negatives are pretty much priced in, and we're digesting a lot of the disappointment. As I mentioned, it's more about fatigue rather than panic right now. So as we see a bit more consolidation perhaps in the first quarter, first half, and we're seeing more either more disappointment, which unlikely, because it's it's like peak disappointment, I would say, in the past few weeks. So it's there is light at the end of the tunnel, I would say.
All right. And on that note, thank you very much, Sandra, for joining us. Always a pleasure speaking with you. Thank you so much for spending time with us this 2025. we hope that you'd spend even more time with us next year. Hopefully the market becomes or gets more exciting for 2026, right?
Definitely. I'm excited. No? Thank you, Mimi.
All right, and happy holidays.
Holidays.
All right.